What should an investor take away from this week in the markets?
Well, it's a part of what investors need to take away is it's going to stay volatile for a while longer, and that's really clear. I think bond markets have started absorbing the fact that the Fed doesn't need to rush in cutting rates. That's also quite clear. Having said all of this, next week we might get good inflation prints and you might get a 15 basis point rally. The problem, as I see it, is that the Fed has been very clear. Jay Powell has been really clear that he would like to be able to cut. I think if he had been in a position to cut already, he would have cut. The data has not cooperated. And so essentially, there is a little bit of whipsaw action happening right now in the bond market, certainly. And the equity market, no comment. I have no comments as to what's going on there at all.
Just off to the races. Well, as you say, whether you call it whipsaw or call it volatility, there's a lot of risks out there that are hard to quantify. We've spent a lot of the program actually talking about a variety of risks, not just economic, but also geopolitical and political. As an investor, when you put together a portfolio, how do you provide the sort of risks that we're seeing right now out there?
So, the reality is, I couldn't agree more with your earlier guests. We are, any one of this series of risks, China and Taiwan, Russia, Ukraine, the Middle East, and the American elections, of course, and the other elections we're going to see around the world, any one of these would have actually been somewhat significant. All of them together, of course, increases in terms of the uncertainty. It increases the potential impact, no doubt. The problem is you can't actually manage your portfolio to one of these risks, because how do you actually handicap any one of these as being likely? You just, if anything disastrous happened in the Middle East or with Russia or with China, clearly, what you'd want to be in is completely, only entirely safe. Maybe you'd want gold. I don't know. That's not how you manage your portfolio, right? So I think for us, what we've done, David, we were very short for a long time with U.S. Treasuries. We've moved to a neutral position. And we are hesitant, I'd say, to go overly long, despite 10 years being where they are right now, in part because the economy is pretty strong. And I'm not sure that the Fed's going to be able to cut as quickly as they would like to cut. So I would tend to agree entirely with Larry. I've been saying September now for a while as being the right time for the Fed to start thinking about this. I also think that the overall number of cuts is not going to be quite as high as markets would like, leading us to that neutral rate of about 4%.
So what does it tell us about duration? I mean, you have cash on the one extreme, you have longer duration on the other. Where do you go? Are you moving toward more duration, Sonal?
So, what I'd say is, what I would advise people to do, cash has worked incredibly well. How can we deny it? It's paying really well. However, it is important to start thinking about increasing that duration. It's not to get massive returns in fixed income. That's not what I'm calling for. We are neutral. I'm talking about moving from overnight and cash towards ultra short, and then slowly dipping into low duration and beginning to move out on that duration spectrum. But the Fed will cut. The one thing I would say, though, is this is not a series of cuts leading to a multi-year rally in yields. I think we are in a different place. If you look at where the fiscal deficit is, you look at the fact that inflation is stickier than any of us would like. Wages are pretty sticky. You've got to accept that fixed income is not going to give you equity-like returns.